Alright. Part 2, specific applications. Road accounting, principles, final report, volume 2, detailed report. This part of volume 2 discusses the major specific regulatory application for the jurisdiction of the Interstate Commerce Commission, which will be effective with the railroad accounting principle. The specific applications discuss the following chapter: Chapter 9, revenue adequacy; Chapter 10, maximum rates; Chapter 11, competitive access; Chapter 12, abandonment surcharge; Chapter 13, minimum rate law and canon; Chapter 14, railroad adjustment factor. Right, each chapter contains explanation of regulatory applications and discussed on how the Interstate Commerce Commission currently carries out the responsibility. Each chapter identifies the 8 railroad accounting principles applied with specific regulatory applications, discuss the pros and cons of application. Where appropriate, the chapter represents the analysis of alternatives to applicable specific regulatory circumstances, also present the discussion impact of the implementation of railroad accounting principles. All right, Chapter 9, revenue adequacy. In the ICA, requires the Interstate Commerce Commission annually to railroad they subject the jurisdiction adequate revenues and state or adequate revenue levels should provide with the recovery expense for the attraction and retention of the necessary capital of continued operations. The Interstate Commerce Commission determined that the railroad has adequate revenue if the return of investment equals extent of the capital cost of the capital rate, with the railroad accounting principle board focus on the revenue adequacy limited economically accurate determination railroad of the return on investment capital cost of the capital rate. Railroad accounting principle will not consider the economic accuracy of the alternative revenue adequacy standard not presently used by the Interstate Commerce Commission, such as it flows the funds of flow ratio analysis of return of the equity. However, should the Interstate Commerce Commission adopt the different revenue adequacy policy in future with the railroad accounting principle board intends to the principle apply with the extent that they are relevant. For the example, the Interstate Commerce Commission selected the return of the equity of the revenue adequacy standard, but they need to assess the valuation and related expense principles would apply, and either any of the cost of capital principles would apply in this part. Application principles to revenue adequacy. The principles would apply with revenue adequacy determination are casualty, practicality, data integrity, and any of the asset valuation related expenses and cost of capital. The time of operation constant of the casualty principle is permanent if the revenue adequacy determination because of the required return of the investment for the period is used for the measure of the ability to track capital with the competitive marketplace is measured for the compare for the cost of the capital marketplace for the same period. Practicality. According to the practicality principle, the return of investment information submitted with the consolidated with the supplement schedule rather than full consolidated with the combined with reports that are accurate for return of investment computation with reviewing adequacy purposes do not require the level of detail contained with the annual reports for the shareholder. The Security Exchange Commission of the Interstate Commerce Commission, however, the return of the investment information should reconcile with the annual report with the information with the sense for the amount of the can be traced. Data integrity. According to the data integrity principle of the data with the developed individual, the railroad and return of investment and industry costs for the capital require the different approaches described below with the assuring data integrity because they obtain the different source of each of the railroad revenue expense of the investment data with the use of the composite with the railroad on the return of investment reported with the RM1 and under the any principle within contents with supplemental consolidation component schedule and filed annually since critical items of these reports periodically adjusted, audited, and used with agreed procedures and independent of the public account. These data must satisfy the data integration principle of the revenue adequacy purpose for the relying established standards. Using the return of the investment data which are filled with our information determined with the industrial cost of the capital rate submitted with the annual ex parte with the proceed with the information based on the sample estimate with the market data, the equity cost of the data, integrity with the cost capital determinations by established through the established Interstate Commerce Commission procedural rules regarding with the presentation support for the evidence, and any principle designed with the portion of the potential complex with conglomerate organization with railroad related business enterprise with railroad entities will provide the boundary of the measurement with the revenue expense with the asset with the basis for the return of investment and computation of the revenue adequacy purpose for the railroad investment and railroad return of investment calculation based on the railroad related activities the effective affiliated railroads of the railroad affiliated other railroad related affiliates and any representation of business entities undertake of the railroad related activities rather than legal entity. The entity principle described the activities considered with the railroad related. However, the affiliation determined the railroad related activities of those were supported with the railroad affiliation. Affiliation determined in accordance with the government accepted auditing principles. Government audit acceptable audit accounting principles. Accurate railroad-related return of investment measurement, the adequate assessment of railroad-related activities, revenues, expenses resulting with the conversely investment measurement should exclude man-related assets and limit ability to revenue expense. However, according to the practically principle, the return of investment measurements may include all expenses of the affiliate assets, revenues expected expenses depending on whether the segregation is impractical. They affiliated with the predominantly railroad-related affiliate is predominantly railroad-related if it cannot exist, but both revenue derived with the support of the provided with railroad operations. Because particular consideration is exclusion for the entire railroad affiliates, the railroad-related transaction between the railroad and any affiliated companies outside of the entity may occur with the two and collide with the economic side effect of such for the transaction between the railroad and any affiliated companies outside of the entity. The transaction should be stated at the fair market value and the computing with the return of investment. The railroad-related transaction with the companies outside of the railroad entity may be produced gains or losses, which include the railroad return of investment in computations. Assessed valuation related expenses. Other mandatory boundary related entities are determined if the entity's assets must be valued to produce the denominator of the return of the investment. The asset valuation and related expense principle is applied with the revenue adequacy provided for the asset valuation in accordance with the government accepted accounting principles. However, the Interstate Commerce Commission determined the acquisition cost is not meaningful. Measure for the value of the particular cost. The measure for the value may be used in individual concluding predecessor costs. According to the asset valuation related with the expense principle, the intent for the deferred tax credit with the balance best subtracted with the investment, unlike the debt and equity source of the funds. Deferred taxes are zero. Cost of the funds. The sense of the purpose of the revenue adequacy determination is assertion where the railroad entities that earning revenues sufficient to attract and which retain the portion of the investment base and with the finance with the deferred tax should not be included with the return of the investment. The return compromise with the return of the investment numerator is also affected with the asset valuation related expense for the principal. The return of compilation incorporates among the expense for the annual depreciation expense associated with the asset base. All right, capital cost of capital. As mentioned previously, industry-wide cost of capital is standardization of the return of investment, generally compared with the determined revenue adequacy, and such as the representative the return required with the track of the return capital necessary for the provision of the sound rail transportation system of the United States. The cost of the capital principle describes the components of the method using while they combine with the product system wing average rate with this percentage of the cost of the capital nominated. Nominal rate compromised with the market equity cost weighed with the proportion of the railroad industry market value capitalization, the debt of the equity capitalization portion is determined with a single year. Analyze the support or ejecting change of the application alternatives affecting the revenue adequacy determination of the considering with the railroad accounting principle board developing the entity asset valuation related expense for the cost of capital principle, the entity, the four alternative entity definition of revenue adequacy of the railroad accounting principle board, the process of combined with related activity. The chapter 5 of the entity contains detailed discussion of entity alternative. The discussion will not be repeated here. However, the summary, but briefly, reasons for the selection of the railroad accounting principle board concluded that the combined railroad related entity was superior to the other alternative for reason. It represents the economic entity performing the railroad-related activity through management with the legal structure of the railroad accounting principle entity with the compatible with the measurement of the performance of railroad activity consistent with the economic entity with the concept of the financial accounting given the not-related regulatory scope. It reduces the potential effect of the manipulation, but through the transfer of economic wealth through the facility of the interest, which includes the regulated debt, and with the consolidation combined with the railroad-related affiliates, economic effect transfers between the companies and eliminated, but the significance of the asset transfer, the transfer pricing with the pricing of materials is reduced. It was a result most effective with the report with the paragraph of the Interstate Commerce Commission with one entity with operating with the entity, although the entity to adopt the railroad accounting principle may result slightly higher with the report cost of the alternative consolidated with the entity with adopt the railroad accounting principle procedure with the greater economic accuracy of the railroad regulatory application. Moreover, the additional report of the cost may reduce the submitting of the context on the schedules, including excluding an entire railroad related affiliates with supporting with the railroad related activities and practical. It enhanced the ability to rely on the internal control of the audit coverage required for the external finance reporting. The affiliates consolidated or ready to be subject to the external audit, therefore they may be easily reconciled with existing financial reports. For some of the railroads, it must closely resemble the entity which enters the capital market with narrow narrower any alternative sense, measuring the ability to track the retaining with the capital with the competitive with the capital market as a result of the railroad operation. The objective of the revenue adequacy determination for the entity should be defined with the performance affecting the ability the resulting railroad entity enhances the comparability between the railroad industry and other industries. Asset valuation related to expenses. Asset valuation cannot be isolated with the cost of the capital rate. Determination of the cost of asset base is either the use of the real cost capital rate or the recognition of the capital gains for losses for the period of time in which the assets are held. Conversely, a history or historical cost of the asset base required for the use for the nominal cost of the capital rate with the accounting inflation of the capital cost since both the asset valuation of the cost of the capital rate include the impact of the inflation of the nominal cost capital rate would be in conjunction with the current cost of the asset base, which would result in the double count of the inflation of the capital cost. Where the accounting principle was considered with the current market value in the historical case, the basic of the asset valuation and selected with the historical cost, not accumulated depreciation. The argument with the current market value evaluation methodology consistent with the economic principle of the value as to determine the opportunity cost. In most cases, the opportunity cost measured with the replacement cost of the assessor with similar per remaining productive lives and capacity. An argument of the historical capital valuation with the issue of the final capacity community with the evaluate the financial the viability industry competing with the capital of the marketplace. Such measurement with the ability to attract with retaining with the capital competitive the capital marketplace for the revenue adequacy determination historical evaluation appropriate. Another argument is the historical valuation of the such cost verifying the current market value estimate of the proponents for the historical valuation state with the survey the practical problems encountered with the accurately estimating with the current market value of the asset base for the estimating the real cost capital. Railroad accounting principle board believe that the current market valuation preferable to historical valuation. Therefore, theoretically, in economic view, when the revenue adequacy application current market value represents the value of the upon the competitive returns must be earned, but the attraction retaining the capital of the mode of directly occurring capital cost and inflation with the asset the valuation reduces the potential of significant variations between the asset specific inflations economy wide inflation rates of encompass with the nominal cost capital rates used in conjunction with the historical asset valuation. Railroad accounting principle the board believe the serious practical problems encountered with applying the current market valuation for the revenue adequacy determination. Unlike other regulatory applications, the revenue adequacy determination requires the valuation of an asset base for the entire railroad entity. While the historical asset valuation may be determined directly for the entity's regulatory maintained accounting versus the current market valuation requires the identification of the value of the remaining of the product of the capacity for the entity's asset. The information not regulatory maintained for the entity's record, the regular valuation of the tax completed with the entity for the identifying the revalue of the existing exists with while not placed in addition with the other set replaced with the kind rather than be incorporated with the technical change of depreciation expense associated with the current valuation derived from the reflective of the composition and life expectancy of the current cost of the asset base. A reliable real cost of the capital rate required with the conjunction with the current cost of the asset base. The difficulty to compute accurately this problem addressed with the further following section. The cost of capital. Railroad accounting principle will consider numerous issues pertaining to the cost of capital rate determination since of alternatives consider each for the issue with the reason for the accepting rejecting with the presenting with the chapter 6 for the focus for the alternative measurement methodology for the significantly influence in this section. One of the three alternatives of the cost capital revenue rate measurement methodologies consider a traditional current nominal and real. Railroad accounting principle will selected with the current nominal cost rate with the four reasons. Substantial portion of the railroad industry traffic base is no longer subject to the Interstate Commerce Commission regulation. A result of a large share of the industry of the revenues determined with the competitive market rather than through the regulatory process. Under the traditional approach of the current market, the debt rates exceed the debt rates of the regulatory lag may be subsequent recovery of the debt on cost competitive traffic. The opportunity cost of the employee will determine the equity cost is applicable to determine the cost of such, since railroad entities must earn in competitive marketplace cost to bid debt with the track with the capital adequacy. The methodology capable of a railroad accounting principle board preference is measured with the capital of the industry based with the revenue adequacy purpose of the embedded with the debt of the cost must be vary significantly among the railroads depending on the age of the composition of the age of the railroad's debt. The particular region with the compensation of the inflation for the use of the current nominal rate is preferable using the current cost of asset and base. Real rate composition, real cost for the capital rate requires an estimate of the expected rate of the general inflation which cannot be observed. Affects the implementation after the Railroad Accounting Principle Board with the principles of revenue, the adequate determination result of the 5 departure from the current Interstate Commerce Commission practices. The definition of control one of the current interstate commerce criteria for determining whether the subsidiary qualifies inclusion with the railroad any with revenue adequacy purposes. The Class 1 railroads must not own the major interest of the subsidiary. The control may exist even when the majority ownership does not present. The definition of affiliation with the confirmation with the government accepting audit accounting principles that any principle incorporate the government acceptable accounting principles concept with regard to the major ownership things requirements of the Interstate Commerce Commission with the final statement representation of the financial accounting safety state standard board with the president with the consideration inclusion of the affiliates with less of the majority owned with made by determining the affiliation defined with the government accepted accounting principles that any principle permits the flexibility to incorporate alternative measures for control that may be required in the future. Interstate Commerce Commission presently requires consolidation combination for Class 1 railroads through under control only if they are a unified jointly managed system. The entity principle does not include the joint managed condition of the consolidation combination. With the elimination of the combination results significant change for the president with the Interstate Commerce Commission and if the revenue adequacy is unclear. Exclusion of the activities presently excluded by the Interstate Commerce Commission, the railroad entity presently defined with the Interstate Commerce Commission only the railroad subsidiaries. Class 1 railroad, the railroad entity defined with the entity principle includes the affiliated railroad and their railroad related. For example, the railroad entity defines the entity principle may include subsidiaries holding companies that would not be included with the interstate commerce definition. Interstate commerce does not include the non-controlled interest of the revenue adequacy purpose. The but-for test. Another current in the Interstate Commerce Commission criteria to determine whether the subsidiary qualified for the inclusion of the railroad and if the subsidiary activities must be integral to the railroad operation is for the but-for existing subsidiary of the railroad would have to create an operation to provide equivalent good of the service subsidiary and considered integral to the railroad operation and include with the railroad entity. While the entity process does not include the but-for test, a practical application for the but-for test is however defined with the entity both the railroad accounting principle board but-for the test point it applies as the difference for the test used in the Interstate Commerce Commission. To pass the but-for test described in the railroad accounting principle, the revenue derived from the support provided with the railroad operation must be essential for the affiliated existence. To pass the Interstate Commerce Commission for the test of operation goods and services provided by the railroad subsidiaries must be essential for the railroad operation. To illustrate the difference between the two and but-for tests, assume the railroad owns and operates a railway car within the railroad company and also controls a subsidiary company with repairs by the parent railroad as well as other non-affiliated railroads. Further, assume that the subsidiary company does not exist for the portion of the parent railroad repairs that presently performed the subsidiary who would have performed the distribution work of the parent railroads other than railroad tax. The subsidiary company could follow the strict interpretation of the present interstate commerce but for the test because the railroad would not be required to create an operation provided with the equivalent services for however they would pass the railroad accounting principle but-for test, assuming the subsidiary company derived substantial revenue from the parent railroad without which it could not exist. Using the governing accepted accounting cost. The asset valuation related exchange principle that required for the value of government accounting accepted accounting principle for the revenue adequacy determination. However, the interstate commerce may be determined the government accepted accounting principle cost a meaningful measure for the value. Certain circumstances may elect another measure for such predecessor's costs. Chapter 10, Maximum Rates.